Hi, this is Jeff Hansen, and I'd like to discuss the performance charts we use in Focus 15 investing. This is a screenshot from Bloomberg of the price history of the Dow Jones Industrial Average, beginning on the left-hand side at around 1920. On the right-hand side of the chart is the current period, very close to where we are now. The scale shows that this is a price of zero, and of course, way back in the 1920s, the Dow Jones was closer to a zero reading. So it goes 0, 5,000, 10,000, 15,000, and 20,000 behind this label. Now, if we look at this, we see, boy, there's a lot of action and increase over the last couple of years. The variability we're seeing is far more dramatic over the recent time period than it was over the early time period. This peak in 2008, this trough is in the first part of 2009, and then the sharp run-up. But it looks like all the variability in prices and all the big increases have taken place recently. But this is what happens when we view things on a nominal scale, where there's a consistent dollar amount between each of these marks. Now, if we look at a different scale, a log scale, we get a different picture. I won't go into what a log scale is from a mathematical point of view, but the important thing that it does for our charts is it gives us a fair image of the risk, the variability over the long performance horizon. And of course, at Focus 15 Investing, we want to make sure to do well over a long period of time. So these long historical periods that we look at are really important to see in their full detail. Now, this gives us a better idea of what's taken place. The same graphical distance, for example, from the peak in 2007 to the trough in 2009, this graphical distance, what's represented by that red triangle, is the same percentage point decline as this graphical distance way off to the left. And this is in 1937. We had a decline that was very similar in scale, in percentage point terms, to what we experienced in 2008 and 2009. So we can see the variability and the very large decline that started in 1929 and ended several years later, and the Depression years. This period shows the run-up during the war. This peak is in 1966, and prices were relatively flat until we get to 1981, and then they move up. This is the internet boom and the collapse, 2008 and 2009, and the current period. And so the variability in terms of percentage points differences over the last couple of years has not been as dramatic as some of these other periods of volatility. And that's shown effectively on this log scale. So again, most of the charts that we use in Focus 15 are on a log scale, and it's just to give adequate representation to the longer term variability of the return series. This is an example of a chart that is from a Focus 15 model portfolio, and this is on a log scale. And if you look off to the left, it's a wealth index, so that's just representing a simple price of the portfolio, and that's on a log scale beginning in this case in January 5th of 1996, set at 100. And that begins here. The traded series is this line moving in a diagonal fashion. And so in a Focus 15 performance chart, when we see a straight line going up with a higher slope than its comparative benchmark, that's a good thing. So that wraps up a quick discussion of using a log scale on our performance charts.